Hello and welcome to Acumen Analysis, the show where we talk about economics, market conditions and politics and how that impacts you and your business.
Welcome to this week's episode of Acumen Analysis, where we're talking about the budget and trying to break it down. But we don't have all the details yet, do we?
Well, we know what's happened, what's been announced. I think the dust is still settling after what can only be described as a shambles. And it's less to do with the content than more about the process. So it starts with the OBR, the Office of Budget Responsibility, whose job it is to, I would say, assess the budget. That's what you'd agree.
Yeah.
And they're meant to comment after the Chancellor has done that speech, that secret sauce of how to make that economy better for all of us. And the budget was leaked early.
Yeah, I think I even saw a video of her realising, or Rachel Reeves realising in the Commons, someone passed her the phone and she looked at it, she realised that it had been leaked, and I think it's not very professional, is it?
No, I think it's a real shame. And I think Kimmy Badenoch, it was in the time, was having a conversation with Keir Starmer. I say conversation, they were having an adversarial debate in the Commons, Prime Minister's questions just before the budget. And had she really wanted to turn the screws, she could have just read out the budget. And that would have stolen Rachel Reeves' thunder. It would have made it very hard. And I think all credit to her, she decided to stay on message and not use an administrative glitch to further her own ends. But, you had that shambles. So that was the start of Wednesday. And then we moved on to after the budget. It's then leaked that the big deficit that was driving all these worries about tax changes and the tax rising
Doesn't exist.
doesn't exist. Exactly. I still don't know what to make of this.
I think everyone was a little bit of shock, because I think there was leak upon leak. It was just normal. We sort of expect that. And in some ways, I think there was a good strategy by Labour to kind of leak terrible things and leak a budget that sounded a lot worse than what it actually ended up being, probably to make people go, oh, well, that wasn't so bad, because they'd already got themselves ramped up for something terrible. And now we've had all this backlash.
Yeah, I think that's exactly right. I think we're now hearing a different story. So I watched the Laura Kuenssberg show at the weekend to assess, interviewed Rachel Reeves. And it seems to me that Rachel Reeves is now saying that there wasn't any good news coming out of the OBR and that they were £60 billion worse off. And that was the reason for everything. Well, that's not the facts that I've heard. But it gives you a background to what, quite frankly, has been a shambolic process. And in the middle of that, we have the substance of everything. One side we've got the rumour mill and then the pre-published budget. And afterwards we've got the background to all this budget is nonsense. But in the middle of it, we have a budget.
And it's worse than that, because this time last year, we were told this is a one-off. We're saying essentially raising taxes now, so we don't have to do it again. And this is something that Kemi has been sort of hounding them about. In fairness,
If I believed every time a politician said this is the only time, I think I would be a wealthy man. So I think yes, and you have to look at the philosophy of a government and decide whether you think that philosophy will mean that they should be repeating a said practice.
yeah.
There we go.
Well, we are where we are on that. So we're talking about income tax, and thresholds have been frozen. We spoke about this in episode 1 of the podcast, which, if you're interested, it's all on YouTube and Spotify, soon to be on iTunes as well. And this is a fiscal drag thing, and I think we did explain it on there, but I think probably worth explaining again what fiscal drag is. Do you want to take that one?
So, of course. The general assumption around capitalism is you're going to grow. So if you grow your profit or your income, so you think you're going to be better off. Now, fiscal drag, as it's called, or freezing allowances, means that you're not going to be as well off as you thought. The government's going to take a disproportionately higher share of that increase.
How does that happen? Well,
They do that by freezing the allowances. So you still pay the same rate of tax, but you're now paying it on a large sum of money. So let's take an example. If you earned £20,000 and the personal allowance, will make it nice and simple, is just say £12,000, you've got taxable income of 8,000 at the rate 20%. That drives you massive getting better, £3,200 of income tax to pay. If you do really well and you grow your income from £20,000 to £22,000, you've increased it by 10%. But they freeze the allowances. So you would normally like to think, well, I've grown my income by 10%. The economy has grown by 10%. I've grown my income by 10%. The allowances have grown by 10%. But if they don't, if they keep the same allowance at £12,000 in this example, and I've now got £10,000 of taxable income, not 8,000, and I just realised before my maths was wrong. You pay 20% at 8,000 is actually going to be £1,600, not 3,200. Too keen to pay tax. Rachel, come after me. So if you're now at £10,000, so 22, that's the fixed of 12,000 allowance. You get £10,000 of taxable income at 20%. You're paying 2,000 instead of the 1,600 that you would have paid before. That isn't a 10% increase. The 1,600 plus the 10% would have been to 1,760. You're paying 2,000. What's that? Fiscal drag.
Yeah.
Your income is growing, but your tax take is going to be a bigger percentage.
it's a good explanation. And I think the freezing is happening until April 2031. And what's really concerning, I suppose, for the common man on the street, or should be at least, is that we expect inflation. We expect, in general, people's pay to increase by whatever that is up until that point, if things are going well. So essentially, a bigger proportion of your income will be taxed. And we've also seen a minimum wage increase, which means that people are going to be earning more because of that, potentially at the lower end. But with this freezing of the rates, those people at the lower end are going to pay more tax as well, aren't they?
Clearly, it will apply universally to everyone. It will bring people in that previously don't pay tax into tax. That will cause sort of the low-income groups will have a bit of a problem with some of their followers, seeing that they weren't expected to do tax returns, and HMRC will be arguing for penalties, etc., when people who have previously never had to pay tax will now have to pay tax. One of the quirks in this is in freezing allowances, the state pension is technically slightly over the personal allowance now. And there's going to be some sort of exemption, but only if your income is solely made up of state pension. So if you happen to have a very, very small pension as a result of, working for a year or so in the private sector, it might be worthwhile trying to cash that pension in now just to avoid the administrative hassle and the additional tax. Not that I'm trying to give you an advice on financial services without the proper thoughts, but it is things you need to think through. The administrative cost of managing that extra tax might be worth more than the capital sum is worth now.
It's a double whammy for people who earn income through dividends, savings, or through property, because we've got a rate increase as well for those types of income of 2%. So we've got property landlords already under pressure. We mentioned it episode 1. I think that's really quite hard for them in particular. Maybe less so for people who earn dividends. I'm not sure.
Well, I think let's take them separately. I think the dividend one is interesting. It's not applied to the additional rate. So those earning more than round about 125,000 don't pay the additional 2% on the extra dividends. It's only on the basic rate and the higher rate tax. And 2% is a lot of money on it. But that seems to be hitting the middle class population, not the wealthy business owners, the wealthy non-DOMs, the wealthy whatever. So it's an unusual levy to apply.
It's also the one-man bands, contractor, consultant, electrician, plumber who might have a limited company.
Absolutely. But it's hitting those that have structured their affairs through a business, and those people that have got savings and they're going to be living off dividends, or he's trying to grow their wealth through dividends. That is the people hit. It is not those that have got a big business or those that have struck the business, their investments through pension schemes or anything like that. Nor is it hitting the sole traders who are paying tax as income tax. It's the dividend tax.
It's also people who might have a share portfolio in their own name.
Yes.
And who receive a dividend occasionally from a FTSE share or a whatever. They will also get hit by that, unfortunately.
Yeah, it means that those people that are earning up to £125,000 are now paying an extra 2% on any income they had taken by dividends. So it's quite it's a noticeable hike. I think there'll be grumblings, but I think again she'll get away with that one. I don't think that's it's a big thing. If they'd taken it for everyone, in other words, those in the additional rate, I think that would have probably been fairer, in all honesty. Why those people with even bigger dividends get away with it is unusual for me in the Labour Party, but it is what it is.
Yeah. So property guys?
Property, so all property income's being taxed by, income tax is up by 2%. I think it's a perennial hit. Every year, there's always got to be just turn that screw that little bit more on the property investor. And at some point, the bubble isn't just going to burst; it's going to explode, and we're going to have properties vacant because landlords just want to sell up and have to have the property vacant to get a proper price. There's a huge threat around that at the moment. Those that are buying through mortgages, there's normally an allowance of a certain amount that's calculated in profit before tax. They're now going to have that little bit more. It's not defined that way, but you can see the banks adjusting their calculations to make sure the tax is paid. If everything stays the same, that means that the landlord's going to have to deleverage and invest in that property or invest in reducing the size of their mortgage. That may trigger people to sell it.
We actually spoke about the impacts. Apart from selling up, there was also the potential impact. If you're renting, you might see your rent go up to cover this additional tax. It's not like the property landlord's just going to say, okay, I'll just take that one on the chin, because they're struggling right now. I mean, we've got clients like on their knees, basically.
Well, there's been 8 years of tax rises.
Yeah.
And in the property sector, I'm not saying it's every year, but I'm sure landlords, this is a podcast, will say it feels like it. They probably had a good time before then. It was probably quite a generous tax regime. People were taking advantage of it, rightly so. And really, it's been turned, in like many things that the public sector and the government seem to think are a good thing. They flog it to death until they've destroyed it. And I do wonder whether we're getting close to those times in the property sector. I mean, the interest rates is probably the biggest issue that they're facing. They've gone from very, very low interest rates to, in the scheme of history, they're not high, but they're much higher than what we've had in the recent past.
It's harder to swallow when it's typically an asset that's low yield, because it is that kind of low risk.
It's low yield, high leverage, stable income, and there's not a lot of wriggle room as a consequence.
Yeah, and then obviously same increase in tax for people who are earning income over savings. So I think that's, again, potentially who do we know that has sort of lots of savings? Typically the people who are closer to retirement. I think that's going to hit pensioners again. Yeah, it's quite an unusual one. If you've got a lot of cash, what are you better doing? Normally you say, look, think about whether you should be investing it, earn a better interest rate, earn some dividends. So the taxman has decided to tax. This 2% is really a tax on wealth. Yep.
It's tackling those that have got property, those that have got savings, those that have got businesses.
Yeah.
Those are the ones that are escaping the additional tax are those ones with sizable businesses.
Yeah, this is essentially the wealth tax that didn't come in many ways, because absolutely you're right. It's from those types of assets. Moving on, we're looking at ISAs, and we've had up until last week, we had £20,000 we could put in for a given tax year, and we had the flexibility of putting it in a cash ISA or an equity ISA. An equity ISA being, money going into equities as opposed to cash. And now we've got this restriction, or this this slight nuance rule that's come in, which I don't think is necessarily a bad thing, and it might be something that improves access to capital, hopefully. What do you think?
I don't think the ISAs generally are working. And there's been, depending on which side of the coin you take it, either you say the cash ISA doesn't work because it's not really stimulated the growth in the economy. And really what you've got is a deposit product delivered by a bank, and the bank puts the money into its centralized coffers, and you're still beholden to whether the banks lend. So nothing's really changed because the banks could have borrowed that money in the money market. So there's no change. Or you've got a situation where you look at the equity ISA, stocks and shares ISA, and the money goes overseas. So the UK is providing tax relief to overseas investors, or to overseas investment, and fueling principally the US stock markets. So I don't think either will work. The Chancellor's chosen to try and increase risk capital, which I think is probably a good thing if he's going for a growth journey, and is limiting the cash ISA. Now, she's reduced the amount of it. I think by reducing it, people are also going to be able to use that surplus. You still get 20,000 a year, but you're limited in how much you can put into cash. The rest has to go into stocks and shares ISA. I can see the logic in it. So he didn't want to say no to it because there was an awful lot of arguments beforehand about abolishing it. But there are people where a deposit-based product will suit them. So she didn't want to alienate those people.
I mean, I don't think there's been a restriction on what type of equities the equity ISA can go into yet. Which, okay, so, you've got this 8K into an equity ISA, which sounds like we're making some risk capital available. But if we're not going to say, and that's restricted to UK listed businesses or UK businesses generically, then we're not necessarily making it available here. We're just saying, potentially we're saying more money, more of our money is going to go and be invested in the NASDAQ or something.
Yeah, I mean, the question will be, if you're an individual who likes to invest in low-risk investments, are you previously done 20,000, let's say 20,000 a year into a cash ISA? What are your options now? Well, the Chancellor's hoping you're going to say, I'm going to max out my cash ISA at 12,000, and I'll do 8,000 into some higher risk economic UK benefiting investment. I don't think that's the way the human psyche works. People that want to do a cash ISA typically do not want to do stocks and shares ISA.
Mm-hmm. It's opposite ends of the risk profile.
Yeah. I think you'll find that they'll just do a high interest account in a bank or a building society.
Yep.
Does that really matter? Not really. I think all that happens is some of the tax relief's been taken. So if anything, you're taxing poor savers again.
Right. The next thing is salary sacrifice. And there's been a cap on how much an employee can take as a salary sacrifice. I think we had a rumor about this, and we spoke about the rumor in episode 2. And I think this is a shame. I think I mentioned this in the last episode, although quite easy to get around.
I just don't think this is a big issue. I think that people who are currently using it, yes, they're going to be caught. But now that you know that's there, the employer isn't going to say, I'm going to give you a pay rise, and then you go, oh, can I commute that into some sort of extra holidays or whatever? What they're going to do is say, no, we can't do that. They'll say, well, we thought about giving you a pay rise, but we wondered if you wanted extra holidays. So you're going to find this sort of, I haven't quite given you, whatever the government's definition is going to be, that triggers you're beyond the point of surrender. So once you surrender, you're going to pay the tax. They'll stop short of that. And I can't see how that's really long-term going to be an effective method of raising tax.
Yeah, I agree. It's too easy to get around that one. So if people want to, they will. Yeah, a non-issue, I think we call that one. Moving on then, and I don't know if we want to talk about benefits on this one, but there's a 2-child benefit cap. It's been a bit of a contentious one being removed.
Well, there are many people on all sides of the spectrum, political spectrum, and the economic spectrum that are not in favour of this. The argument in favour is about fairness
and lifting people out of potentially poverty and stuff.
Yep. So the alleged numbers I thought it was 100,000 people being lifted out, but apparently now 500,000 people being lifted out of poverty, our children out of poverty. So let's be clear, it's a good thing if it can change their long-term outcomes. The long-term prospects need to change, and then it's a good thing. The question is always going to be, can we afford it now? So, we've got short-term challenges. Everything that the Chancellor's done to raise money is to raise money now or in a few years' time versus a payback for this two-child benefit cap removal is a generation away.
Yeah, it seems like it kind of goes against everything else that's been coming through the budget. Obviously, the whole point is, before the OBR came and said the black hole doesn't exist, Rachel was saying, okay, look, we need to fill this gap. We're going to have to all contribute in some way, shape or form. And then this comes out and it feels like that's just money out the door, just from a pure economics perspective, taking out the benefit side of it.
Most people that say the money doesn't get used wisely, it's not efficient way of expenditure lifting people out of poverty. I'm sure there'll be an element of truth in that. The more data is probably needed. But some families have made a decision to only have 2 children because they're trying to provide a certain standard of living. They've made that decision.
Yeah.
And then now that decision is particularly in jeopardy. It may be too late for them. Maybe life's different. So it is quite a hard one. And then I heard Rachel Reeves again and watching Laura Kuenssberg at the weekend, saying 60% of people are going to benefit are already working. So you freeze the allowances, so you take some of it back, and you're giving it, it seems to be
mixed messages.
Yeah, I'm not quite sure on this one, I have to say. I see the long-term benefit of it. I'm not sure it's overly efficient, but I see the long-term benefit. I worry that we need a short-term need now.
Yeah, and another one that's, although probably fair, opposing the sort of the narrative from the rest of the budget is the 4.8% increase in state pension.
Well, yes, I think I don't really have a massive view on that. I think there needs to be a general grabbing and grasping of the total cost of running the public sector. That's state pension, that's welfare benefits, the whole lot, and give it a shakedown to work out what is the right number. I don't want to be caught picking and choosing between individual elements that are, 4.8% is inflationary. Is it right? Is it wrong? That's a political judgment. I think there needs to be a wider thought process around what the people, the citizens should be paying towards, and how that money is divvied up into the various pots of money and rooms for.
Yeah, it's another one of those, just in the same way that, in my belief, the income tax threshold should be going up by inflation. I think that should also be going up by inflation. And that's not the way the life works always. But, in utopian type world, I think that's the right thing. Next one is energy bills. And there being a cut of roughly £150 per household, I think.
I think this is interesting. This is effectively giving up on a large swathe of saying that the green is the way forward. And, this is, I suppose, driven by Trump's agenda. And the whole world is gradually deprioritized climate change in the favor of economic progress. We'll all have a view as to whether that's right or wrong. But, what we've done here is the subsidy that we're all paying for that goes behind the scenes to the energy companies to invest in renewable initiatives has disappeared. And instead, there's going to be a line directly on our bills for that. And on top of that, we're getting £150 a year off the bill. So I think that's a nice contribution. What I think is a little bit unfair is the wealthy are getting just as much as the poor. That is something that if they'd done it to the rate of energy, it would have been worse. But you could have means tested it in some way for only annual bills of less than a certain percentage and make the money more meaningfully spent, because those earning, let's say, 50,000 or more, £150 a year probably isn't that important, but there's someone earning 20,000, it could be quite significant.
And there's also been a commitment to spend about 1.5 billion on the grid and various infrastructure improvements around energy.
I think that's really important. I think the UK's productivity is very poor, very low in the, for the level of the size of our economy. we're very inefficient, and that's largely infrastructure driven. It's not how hard we work. We're all hard working. It's we're held back by the tools that we've got available to us. So internet speeds, electricity, power, potholes in roads,
Transport, yeah,
bridges not working,
trains.
whatever it is. Yeah.
And I think over the last sort of 20 years, it's been said that actually the UK has had very little investment in its own infrastructure, meaningful investment. I mean, if you look at HS2, that's just money down the drain, I think, in many respects. But this is quite a welcome sort of change, perhaps.
I think it's interesting if you look at what's going on in every sector. We've got schools that are crumbling because they weren't built correctly. We've got councils that are struggling financially, so potholes are persisting for too long. The NHS has got waiting lists through the years needing to modernise with new treatments, etc. AI is going to take away everyone's jobs if we can get if the power can come to other countries and not to us. So there's a huge need for investment, and I worry whether 1.5 billion is anywhere near enough. But, let's be absolutely clear. It's a great start, but it might need to be 10 times that just to even scratch the surface.
I'm hoping that 1.5 billion in part goes towards battery storage for electricity, because I think my understanding is right when I say that there's huge amounts of wind farms being switched off because we can't deal with the electricity that's coming in say an off-peak time. There's nowhere for it to go as such, and we're spending a lot of money on that as a country.
Yeah, so the UK's got wind power, and you can't choose the demand. So let's say that you can't choose the supply of when wind will come, but the demand will arrive whenever the UK population wants it. So you're probably able to predict your demand because it's probably most people home from work at a certain time, etc. You can pick your demand for electricity, but you can't choose when the wind's going to blow.
Yeah.
So batteries provide that buffer. In the same way, nuclear is a very good baseline solution because it's always on, but it's not very good for your top-up needs. And again, batteries might be the way to deal with that.
Well, on the subject of electricity, there's now a road tax, 3p per mile for EVs. That's something that I've seen a lot of rage about on LinkedIn, especially with business owners having been incentivized to go and buy electric cars and now feeling a little bit shafted.
Well, I certainly can feel that, and I feel their pain as much as hearing it. I've got EVs myself, and as you know, our business, we've said any company cars are always EVs, so we're going to be hit by that. But let's be clear about it. There's been a tax benefit. It's meant that the government's short of road revenue, for want of a better word, because of the discount, and it's come up with a method which is what I call discretionary spend. I think if you want to drive your car, you pay. If you don't want to, you get public transport or walk or take the bike. I get it. For some, that will be impossible. But for many, you've turned a tax, you have to pay road tax, into something that's discretionary. I'm not sure it's going to be easy to implement, though, because the current talk is it will be on your MOT certificates. But what happens if you went and took your car to France and a summer holiday and drove 1,000 miles in France? That shouldn't be taxed in the UK.
That's a really good point.
So I don't quite know how that's going to work in the detail.
Didn't even think about that. This is these little bits of detail which we haven't yet got from the budget. I mean, we've got, at the moment, quite high-level summary, haven't we?
Well, we need to go into that detail, that the legislation has been published, and see how it goes through. But we've also got to think through is this a fair tax? In London, you can be an hour on the road and not go very far. If you were in, let's pick a rural place, anywhere in the UK that's rural, you can go a lot further for an hour.
Scotland, for example.
And who's going to pay more tax? More of this 3p a mile, it will be those in your rural areas. So this is a tax on rural population where they don't have the option of public transport either.
That's a really good point.
So
yeah.
it's a tax that I think is hitting the wrong part of the economy, where you need to make sure the rural economy is thriving because there's less opportunity to create economic value versus the cosmopolitan, the cities where the people are. So again, I'm not sure it's the right one, but it is what it is. And I think the administrative mechanism may see this watered down quite heavily.
It's a really good point. I haven't heard anyone mention that fact that, yeah, you're right. People who live in big cities and largely stay in big cities, London, for example, you could be a taxi driver and only be doing short journeys a lot of the time. But if you're a taxi driver, say, well, this is on individuals, isn't it?
Mm-hmm.
So that's completely irrelevant for a couple.
But he'll be taxing both. He's taxing your car.
It's taxed on the car itself, yeah. Okay. So a taxi driver could be in like, say, Buckinghamshire, where I'm from, or Scotland, from, where you're from. The same 100 miles might not equate the same amount of income for them compared to London, where it'd be like loads of short journeys. Yeah. That's quite big, actually. The next thing is on the fuel duty P cut. Sure, welcome to many. Fuel is one thing that kind of hits everything, isn't it?
Yeah, I think this is about the only pro-business measure that I saw. Look, every cut's welcome. I think fuel's been quite a hit for people in recent years, quite an emotive subject. So I think this is welcome.
Especially when it hits the price of everything, your Tesco goods, your Amazon deliveries, that works its way into all the prices, I think. The next one's on rail fare fees. That's been frozen for a period of time. I'm not sure how emotive this one is. I think train tickets are quite expensive. If I'm coming into London from where I live, it's like £38 return just for a single day. That's huge if people are doing it on a daily.
I think generally speaking, we have quite expensive rail tickets compared to the rest of Europe. What I don't know is to what extent they're subsidised in the rest of Europe. But anything the UK railway is built on, I was going to say decades old, but it's longer than that, centuries old infrastructure, and building on top of building on top of all. And it's just old stuff at the bottom of it supporting everything. And they modernise it, but it's difficult, this modernising. So it's an expensive railway to run, and it runs with subsidy. So if the government says you don't have to pay, you're not, what that's saying is the government is going to pay that subsidy. And if the government doesn't want to pay it, it just defers projects. It won't approve to pay for this railway upgrade, this new bridge upgrade, this train station upgrade. So it becomes an issue around access and quality of service. I think people in the short term will be delighted to not have to pay for more increases in rail fares, but it will have a knock-on effect.
Moving on to one that definitely is an emotive one, or at least for the wealthy few that are lucky enough to own a mansion, or a mansion defined by Rachel Reeves at the very least. And we've got the mansion tax. We did speak about this in episode 2. We're not sure. We spoke about it back then. We're not sure whether it raises enough money to be worth the angst, but they've talked about a 2 million threshold, 2.5k a council tax increase essentially, and then for a £5 million home, 7.5k.
They're testing the water, in my view. This is the tax is good to run. They've picked out the definition of wealthy, and they'll form a view with think tanks and surveys to work out whether this is the right level or whether the level should reduce. And, 2 million is what it is. It was used for IHT purposes where the additional nil rate band got clawed back. So there is logic to it in that sense. Is it the right level? Not sure. Is it doing its job? I don't think it's going to raise enough money. I think if you're looking to do a big tax, it's got the political dynamite behind it, whether it's supporting or whether it's against it. It's a fair amount of political capital you're putting behind on this policy. You'd want it to be substantial. And I don't think from the numbers that looking anything like what we should be raising. So I'm £2,500 per annum for a property of £2 million. It sounds an awful lot. But for those people that, even those that are mortgaged up to the hilt with a £2 million mortgage, they can probably cover £200 a month, which is broadly this money. And that only gets easier when you're mortgaged up to the hilt with a £5 million property. So I don't really think this is enough tax. It's not going to be welcome. But if we are talking about politicians putting their political capital on the line as a this is the right thing to do to solve the economic finances of the country, this doesn't raise enough money.
And I suppose the thing that interests me the most is how this impacts society as a whole, because like we've said in the previous episodes, tax always changes decisions and impacts life in ways we wouldn't always expect. I can imagine London property prices having a real hard time with people deciding to leave the likes of Mayfair, Chelsea, and other expensive places, and possibly buying really nice sized houses that are within a commuting distance of London, for example. Is this another COVID surge of the sort of home counties?
I don't think that, if I had my £20 million penthouse in Mayfair, I don't think £7,500 a year makes any difference. And if you want to let's be less extreme than the Mayfair properties. Let's say we're moving out to Berkshire, right? And we found a house that's below 2 million. I think they exist in Berkshire as well. So you can get one. Look at your cost of your rail fare. That is your 2.5K gone. So I don't really see, this is just the cost that people have to bear. There is a worrying sense of direction that this is the government testing it. And going forward, we're going to see this ratcheting up like many other taxes over the years.
And certainly fiscal drag on this. I mean, let's face it, that's a threshold that is only ever going to stay still or go down the way, unless a right-wing government comes in and says this was ridiculous.
Yeah, like even the right-wing governments tend not to cut taxes. They tend to not increase them, but they don't very few governments have cut taxes. Democracies don't encourage it.
Yeah. Do you think, I mean, putting aside the 20 million penthouse in Mayfair, there's obviously
that home that I've got, yes,
the home you wish you had. Do you think there's a significant proportion of properties just over the 2 million mark in London where we will see price changes as a sort of mass?
There's always going to be something, okay, but it's hard to see. London tends to be a younger person's city. People are in the middle of their careers, they're growing it, they're driving it forward, so it's a cost to bear. The ones that are going to suffer are those that are the other end of that journey, and they're retired and are with a large house they want to keep so they can pass it on to children or entertain the grandchildren and whatever. But their income is capped. For them to pay the extra money, that is where will squeeze them, and that's where the problem is.
It's normally people at that end of life who are trying to make their life as cost effective as possible because they're just trying to eke out what they've earned over their sort of working career.
Yeah.
So moving on to businesses and investment, first thing we're kicking off with is VCTs. And for people who don't know what that is, it's essentially venture capitalist trusts, which is a special type of entity, isn't it, that is allowed to invest in startups.
But the change is that these companies, which typically raise money in order to invest, and they're normally professionally managed investments, so with a fund manager looking after them. These companies, these investments by private individuals attract a 30% reduction in people's tax bill.
30% of what they put in?
Of their investment, of the qualifying investment. That investment relief is now being reduced from 30% to 20%. That will make VCTs less attractive.
To individuals.
And
I think this is a bit of a shame because VCTs is one of those things that actually it pushes growth. If you've got a pot of money assigned to startups, it's that risk capital we've talked about in previous episodes, and it's actually a bit of a shame to see that incentive go down. If anything, I would have, if I was looking to grow the economy, I would be saying let's make that really 40%, and try and get as much money into there as possible.
I think that's right. I think this is very anti-growth. You grow the economy better through growing small business than you do by growing a big business, because a big business can have a strategic shift and move overseas. The small business tends to be tied by the friendships and geographies and the local relationships that a small business owner has. So I think this is, I'm not going to say it's completely destructive, but it's definitely an anti-growth of the UK economy.
It's not helpful. EMI schemes, which stands for Employee Management Incentive. The thresholds have changed from 30 to 120 million revenue and 250 to 500 staff. So what sort of impact does that have?
Well, I think when EMI started to be a good number of years ago, the thresholds haven't really moved. And this is a way of acknowledging that to keep the system current and effective, they need to allow what are now seen as bigger businesses in the numbers than what would have been then. So it's part inflationary, part recognizing the climate. And I think this is good news. I think it makes more likely that the employees will get the opportunity to have some sort of incentive-based reward, which is based around shares, and therefore not drawing cash out of those businesses, which, quite frankly, with a tax raising budget, might be struggling a little bit more than would it normally be for cash. So it's a positive.
Probably helpful for us to explain what the scheme actually helps to achieve. 'Cause it's all about tying management in for the long term, isn't it?
Yeah. So when you employ staff, you often pay them a salary. And for senior members of staff, you're normally looking to reward them based on performance. And that reward can come in many different shapes and sizes. And the tax man says, well, you got that reward in connection, and that's the word, it's quite widely defined, in connection with your employment. So we're going to tax it. Now, there are certain exemptions allowed. And one of them is if you give shares to an employee under an EMI scheme. So it falls within the banner of EMI. So the options would have to be exercised within 10 years. The price at which the options were issued have to be at least the size of the price of the shares would be now if they were listed. So, it's future growth you're sharing in as opposed to historical performance. It's all about, can I take an existing business and incentivize staff to grow it? So it's a really useful tool.
And how do these thresholds impact which business can use the scheme and which ones can't?
So you have to be a qualifying business. So you've got to have certain criteria around your trading, the size of you. It doesn't apply to massive, huge businesses because they don't need an incentive to avoid the growth with individual staff. They should be beyond individuals making that difference. So there are size thresholds capping it. There's business activity thresholds that cap it. And
so these thresholds mean businesses over these thresholds are not able to use it because they don't need it.
But once they've issued the options, they can keep them. So they don't get clawed back.
Yep.
So if you're just below it by £1, first I would suggest you get clearance from HMRC if you're that tight in the threshold. But if you're below the threshold by £1, that's fine. And if you do grow and you go over it, the employee still keeps his benefit without having been taxed on it.
So what we're saying right now is that this increase in thresholds means a lot more businesses will be able to use the scheme and possibly benefit the growth of businesses across the UK.
Yeah, I don't think it'll have quite as big an impact as that is the way you've made it sound there. There will be more businesses undoubtedly, but we're asking for a business that's worth 30 million to now being a business worth 120 million. How many businesses fall within that category?
Yeah, true. Good point. And there's also a change in the amount of years that you can have an option that you then exercise, going from 10 years to 15 years. Do you want to explain that, unpack it?
Yeah, so when you receive an option from your employer under EMI, you have to exercise it within 10 years. If it says you've got 11 years, it doesn't qualify as an EMI, and you would be taxed on the value of that option under employment law with NIC, etc. So what we've got here is we've got a scheme now that they've extended the 10-year threshold to 15 years, which means that you've got more time for that business to grow and to create what's called a liquidity event, at which point the employee might say, I've now got enough money from this liquidity event that's coming in a matter of days to exercise my option and get my value. So you're really saying that this is 15 years to grow as opposed to 10 years to grow.
Yeah.
Which I think is definitely better for the employee, allows for the ups and downs of small businesses a bit more. And I think is a positive sign. Most people would like to be able to exercise their options sooner rather than later.
Yeah.
So it shouldn't really affect anything, but it will reassure people, which will tie them to that business to make the difference.
It doesn't tie an employer to give the options based on that extended term. They still have the flexibility for it to be shorter. It just gives more flexibility.
Well, the employer can say any conditions they like, so long as it meets the criteria. So they could say you only get it if you double sales within 3 months.
Yeah.
that might be quite a hard task and not really much of an incentive. It might be a disincentive. But the employer can do all those sort of things, but there are some big parameters which have to be met.
Yep. There's a little silver lining that they're reducing the requirement to report this ahead of time.
So the new changes come in from April 26, and you're still meant to report within 92 days to HMRC, but the need to report is being abolished from April 27, which again just makes it an easier thing to deal with.
Yep. That's really good. And with regards to corporate tax, I'm just moving on slightly. There's been very little change. I think I was expecting a lot more. It's been kind of uneventful in corporate tax kind of side.
Yeah, I think that's right. There's been a little bit of tax revenue from capital allowances, which is the relief that's given for investments into plant and machinery, whether that's vehicles, whether that's lighting and various other, machines, computers. So that relief has been reduced.
But for people who don't understand the way that often works, I mean, there's multiple different types of assets, but your main pool has always been you buy assets, and those assets that qualify, you get what's called a written down allowance, which is it's like depreciation but for tax. So you sort of get 18% per annum in little chunks, and that's for the tax relief. And there's been a change in that in respect of leased vehicles. Is that right?
So leased assets. So there's been various quirks and complexities over the years, and they're reducing the benefit. So there's been what's called a first year allowance, which said if you meet the criteria, you'll get what's called full expensing. You'll get a straight tax deduction for the cost of that asset that you purchased, which goes straight against your tax bill in year one. You need to do the bit over time, the 18% a year. What they've done is said, well, hold on a minute, we're not going to do that under certain circumstances. We're going to limit that first year to 40% allowance, and then the rest over time. So that's there for the complexity of leased assets, etc. It's not a big change. It will affect certain industries, clearly, those particularly involved in the leasing of assets, whether they're on the lessor side will probably be affected more.
So what we're going to see businesses doing is maybe buying more of their assets as opposed to leasing because they get more tax relief.
Yeah, I mean, you'll see the elections slightly differently. I think time will tell how that'll play through. It's going to require leasing is effectively a funding mechanism, so you need to see how the funders wish to interpret that legislation.
Yeah, interesting one. And moving on, and in some way connected to some of the investments or the exits strategies and
employee ownership trust.
Employee ownership trust, and this has gone down from 100% to 50%.
So employee ownership trusts they sound very attractive at a high level. The devil is definitely in the detail here. This is something where if you sell your business, or the majority of your business, and it has to be the majority of your business, to an employee-owned trust, there is no tax on that sale. You're exempt from capital gains tax. And that's a huge benefit. But when we start thinking about that a little bit more, you start realizing some of the complexities. Do the employees have enough money to buy that business? So are you selling it under value? Can they borrow that money? Well, they haven't got a track record of running it because it's your business and you're exiting it. And what happens if they say you'll pay you over time? Can you trust them to run it well? Well, with a non-employee ownership trust, that all rests with you. That's the price of the tax relief. You can't control that business. You've got to let the trust, which now has at least 50% plus one, control, and it will have active control for the benefit of the employees. No matter how important you think you are, being the founder or retaining 49%, doesn't matter. The trust now controls it. It's also got to be around for 10 years of the tax relief clawed back. It's a very useful relief. You got full exemption from capital gains, but now it's going to be at 50%. So you'll pay effectively capital gains tax on half the proceeds, half the gain, not half the proceeds, half the gain.
I'm not sure I've seen many people use it, actually.
It's quite attractive for certain industries. Typically, it's where the business has probably reached the end of its growth journey and it can't grow significantly more because there are some consequences on these employees who end up with the ownership.
Mm.
They don't quite get the same as what the founder or the seller had. So it's a useful method. It's not as widespread as the headlines would make you think it is. It's a really surprising policy for Labour. This is you'd have thought employee ownership trust is exactly what Labour are there to promote.
I was about to say that.
More employee ownership of businesses, and now this tax relief has been reduced. I don't think it's a big tax raiser either.
Yeah, if I was Labour, I'd be sort of saying, if anything, we want to incentivise more of this type of thing, so that we're bringing the people who are typically an employee to being an owner of a business. We're bringing those people up the pay scale almost, and it seems like the opposite of that.
It does.
A very quick one on gambling tax, because we don't have tons of clients in it, although we do have some that provide software to the gambling sector. The tax levies, the levies have changed from 25 to 40%.
Well, the big thing to say about the gambling industry, there's two aspects. Bingo's getting some relief. So Full House and all that. Bingo. Yeah. And the mainstream gambling, those with premises are going to be not affected really. It's the ones that have got remote gambling. That's where there's going to be an increased tax coming through. So those remote operations, those online gambling issues or ventures are going to be paying more tax on the UK betting.
I'm not sure if it's going to impact anyone in particular. I think in general, this is not going to be an emotive one. It's one that it might raise some money. I'm not sure how much.
I mean, the real question is, how do the overseas, because most of these online gambling establishments are established overseas, how are they going to deal with it? They're clearly going to comply with the law and they're just going to have to suffer it. But at some point, they will invest less in serving the UK economy, whether that's in recycling through sponsorship or whether that's, the payouts of these products have is slightly less.
I just wonder whether we'll see the odds on whichever app it is change and get worse. Because one thing you know for certain is the house always wins.
Exactly.
One that is a bit more positive, and definitely one that was a bit of a surprise, is the stamp duty relief in relation to LSE shares.
Yes. So currently, if you list, you pay, well, not on the listing, but any subsequent sale, you pay 0.5% stamp duty and on your transaction value. And to go into the, crest, you pay an upfront element of equivalent to that. And really what they're now saying is stamp duty reserve tax. So this is stamp duty, but not for property, but for shares. That's going to be abolished for the first 3 years after a listing. So that's really to encourage liquidity in the market, which is, if you look at AIM, that's one of his biggest drawbacks is the costs of buying and selling are prohibitive because the shares don't move enough. So hopefully this is all going to start driving more liquidity, etc., make it more attractive so that we can start regaining some of that lost ground that we've had in our UK stock market.
Yeah, I think it's a real shame that although this is positive, things like the VCT tax rate going down, things like the ISA, the 8K equity ISA, a shame that hasn't been allocated specifically to LSE. In my view, that could have all tied together to make a lot more liquidity on the market.
Yes, I think there's a holistic view there. I think it would be quite hard for the Chancellor to have said the stocks and shares ISA, the 20,000 or the remainder of what's left after the cash ISA, the 8,000 ISA, is going to go into the stock market in the UK stock market only. Because if it doesn't grow as much, you're asking people to get tax relief if it's not as good an investment. Personally, I think there is an argument, and the Chancellor could have made that argument and said, if you want tax relief, it's got to be invested in the UK. But you don't want tax relief, that's fine. No one's forcing you.
It's not dissimilar to the SEIS and EIS relief. I mean, you get an enormous amount of income tax relief because you're risking your money on this tiny little startup that might die. It's not dissimilar in that way of thinking.
I get that.
Last one, which I couldn't care less about personally because I don't drink these, but it's a sugar tax on milk drinks, but milk-based drinks.
This was interesting because when I first looked at it, it's you go, oh, okay, so all drinks with milk in it are going to be caught, and then you think, what about my tea,
my coffee?
They've got an open cup, and an open cup's exempt or doesn't pay this extra tax, but a closed cup. So if I go to Starbucks and ask for a cup of tea, it comes with a mug with a lid on it. Typically.
You need to ask for them to not put the lid on.
Well, that might well be what we're doing. You might find they don't put it on because the system say we don't want to have to pay the tax, so we won't. You have to put the lid on yourself, and it's over there in the corner. I mean, it might be something like that, but I think what they're meaning, from what I can see from the interpretation, the analysis, is open cup is meant to mean
Freshly made?
freshly made. Yes, that's exactly right. So if you buy something that's in a carton and sealed, chocolate milk, then you are paying that tax, ready to drink, but not freshly made.
So if you're buying a pumpkin spice milkshake from Starbucks, possibly not a problem. But if you're buying a prepared Yazoo bottle from Tesco, you're going to pay a bit more.
Yes, that's right.
Yeah, okay. I think that's most of it. I feel like there's a few I've missed, but I'm sure we'll find another episode to unpack a little bit more. There's an awful lot more of detail yet to come on this budget, which at the moment we've had super, super high level in many sort of areas. Certainly been an interesting one.
Well, I think all the interests are in the noise around the budget, not so much the actual budget itself was relatively benign compared to what we were expecting.
Thanks for joining this episode of Acumen Analysis, where we've unpacked the budget. On the next episode, we're going to be looking at the jargon we see in business and breaking that down for you and your business so that you can understand those things better. We're talking inflation, we're talking VAT changes, interest rate hikes, minimum wage impacts, import duties. See you next time.